The timeless wisdom of Warren Buffett is a concept that encapsulates the enduring investment philosophies and life principles of one of the most successful investors in history. It refers to the fundamental strategies and insights that Buffett has consistently applied throughout his career, which have proven effective regardless of market conditions or economic cycles. The significance of this wisdom lies in its simplicity and practicality, allowing investors to navigate the complexities of the financial world with clarity and confidence. Buffett's approach emphasizes long-term value investing, understanding businesses deeply, and maintaining patience and discipline, principles that offer stability in a world where financial advice often leans towards the fleeting and speculative. A prime example of Buffett's wisdom in action is his investment in Coca-Cola. In the late 1980s, recognizing the company's strong brand and global potential, Buffett invested heavily, a decision that exemplifies his belief in buying quality businesses at fair prices and holding them over the long term. Another instance is his acquisition of Burlington Northern Santa Fe Railway in 2009. At a time when many doubted the future of railroads, Buffett saw intrinsic value and long-term growth opportunities in the industry's role in the economy, highlighting his ability to remain steadfast in his convictions. Supporters of Buffett's philosophies argue that his rules provide a reliable framework for financial success. Notable figures, including Charlie Munger, Buffett's longtime business partner, advocate for his principles, emphasizing their effectiveness in cultivating sound investment decisions and fostering a rational approach to wealth building. However, some critics point out challenges and controversies surrounding Buffett's strategies. For instance, his focus on large established companies may not appeal to those seeking more aggressive growth from emerging technologies or markets. Additionally, Buffett's emphasis on a long-term horizon might not align with investors who prioritize quick returns. Despite these potential challenges, Buffett's timeless wisdom profoundly influences the broader investment landscape. It encourages investors to prioritize thorough research, value over trend chasing, and a steadfast approach during market volatility. This philosophy not only shapes individual investment strategies, but also underscores the central themes of financial resilience and prudent decision-making within the broader topic of mastering Buffett's rules. By adhering to these timeless principles, investors can achieve greater stability and success in their financial endeavors. One of Warren Buffett's core investment philosophies is the idea of focusing on what you know, often encapsulated in the principle, invest within your circle of competence. This concept is grounded in the belief that an investor should concentrate on areas where they have substantial knowledge and understanding, allowing them to make informed and rational decisions. The crux of this rule is not about limiting oneself, but rather about optimizing one's strengths, which can mitigate risks and enhance decision-making. By investing in industries or markets they understand, investors can better evaluate potential risks and returns, leading to more reliable investment choices. The importance of this rule lies in its ability to prevent investors from venturing into complex or unfamiliar territories where their lack of understanding could lead to poor judgments and significant losses. Staying within a circle of competence allows for more confident and informed investment decisions. For instance, a tech-savvy investor might focus on companies like Apple or Google, where they have a keen understanding of market trends, competition, and technological advancement. Similarly, a professional with deep knowledge of real estate might focus their investments on property markets they've carefully studied over the years. One supportive opinion comes from Buffett's own track record. He has consistently outperformed the market by adhering to this rule, showcasing its effectiveness. However, there are potential challenges associated with this approach. Critics argue that staying within a limited zone might cause investors to miss out on lucrative opportunities in emerging sectors or industries. Moreover, the market is ever evolving, and one's circle of competence needs continuous updating and learning to remain relevant. Additionally, there is a risk of overconfidence within one's perceived circle of competence, leading to potential oversights. To address this, it's crucial for investors to engage in continuous learning and remain open to expanding their expertise gradually. This principle is deeply interconnected with other aspects of Buffett's investment strategies, like the emphasis on long-term investments and thorough research before making decisions. By understanding one's circle of competence, investors can not only make prudent investment choices, but also maintain discipline, avoiding the herd mentality that often leads to volatile market swings. Ultimately, this rule influences how investors approach risk, manage portfolios, and align their investments with their personal and professional insights. Understanding and applying this rule can set a solid foundation for achieving consistent and sustainable investment success. Investing in what you understand is a foundational principle advocated by Warren Buffett, emphasizing the importance of familiarity and comprehension in investment decisions. This concept suggests that investors should focus on industries and companies they are knowledgeable about or can easily comprehend. By doing so, they can make informed decisions, understand potential risks, and assess future prospects effectively. The significance of this rule relates directly to its ability to minimize blind spots and reduce the reliance on speculation, thereby protecting investors from unforeseen pitfalls. One real-world application of this principle is Buffett's own investment strategy. He famously avoided tech stocks during the dot-com bubble because he did not fully understand the business models and long-term prospects of these companies. His decision to stay away from technology investments during that period helped him avoid the crash that followed, showcasing the value of investing within one's circle of competence. Another example is his investment in Coca-Cola. Buffett understood the beverage industry, recognized Coca-Cola's global brand presence, and saw the potential for long-term growth, leading to one of Berkshire Hathaway's most successful investments. Supporting opinions for this approach often highlight that understanding an investment allows for better judgment and less susceptibility to market hype. Investors who know their industries can better interpret news and market developments, leading to more stable and confident investment decisions. However, there are potential challenges and controversies with this strategy. Critics argue that this approach might lead to a lack of diversification, as investors may concentrate too heavily in familiar sectors, potentially missing out on lucrative opportunities in emerging or unfamiliar markets. Additionally, some suggest that the financial world is increasingly complex, and sticking strictly to what one knows could mean falling behind in rapidly advancing sectors like technology. To counter these challenges, some investors advocate for a balanced approach that combines understanding with a willingness to learn about and gradually enter new industries. This rule influences other aspects of investing by encouraging deeper research and due diligence. It aligns with Buffett's emphasis on long-term investment, risk management, and maintaining a rational approach to market fluctuations. By investing in what they understand, investors not only safeguard their capital, but also set the stage for sustainable growth and opportunity identification, making it a crucial tenet in the broader framework of successful investment strategies. One of the key principles attributed to Warren Buffett, and often highlighted in discussions of his investment success, is the idea of investing in what you know. This rule underscores the importance of understanding the businesses or industries in which one chooses to invest. Buffett advocates for a focus on companies and sectors where the investor has substantial knowledge and insight, minimizing risks associated with unfamiliar territories. The significance of this rule in the context of Buffett's overall investment strategy cannot be overstated. It reflects a cautious and informed approach, allowing investors to make well-reasoned decisions rather than speculative bets. By investing in familiar areas, individuals can better anticipate industry trends, understand competitive landscapes, and more accurately assess a company's potential for growth and profitability. Real-world applications of this principle are evident in Buffett's own investment portfolio. For instance, his long-standing investments in Coca-Cola and American Express showcase his deep understanding of consumer behavior and market trends in these sectors. These investments have consistently rewarded him with significant returns, reaffirming the value of investing in well-known businesses with enduring competitive advantages. Another example is Buffett's reluctance to invest in technology companies during the early years of the tech boom, due to his lack of familiarity with the sector at the time. This cautious stance helped him avoid losses during the dot-com bust. Opinions supporting this idea often highlight the reduced risk of investing in familiar areas. Investors like Peter Lynch echo Buffett's sentiment, emphasizing that understanding what one owns leads to more informed and confident decision-making. However, there are challenges and alternative viewpoints to consider. Critics argue that confining investments to familiar industries might limit opportunities for diversification and growth. Additionally, the rapid pace of technological and market changes means that staying confined to a narrow focus could result in missed opportunities in emerging sectors. This principle of investing in what you know influences other aspects of Buffett's philosophy, such as the emphasis on long-term value investing and the avoidance of herd mentality. It interconnects with his broader strategy by promoting a thorough analysis of potential investments and a disciplined approach to portfolio management. By adhering to this rule, investors align themselves with a strategy that prioritizes wisdom, patience, and a deep understanding of the market, ultimately contributing to more stable and consistent investment success.